Good morning, dear students. Today we are going to go ahead with the next part of investment decision, that is problems when cash flows before tax is given. Okay, if you remember in the previous all the videos and problems that we have solved, the cash flows after tax was given to us. So we used it directly for the calculation. In this particular problem, the cash flows before tax are given. Always remember, whenever we are solving any problem on investment decision, we have to first convert the cash flows before tax into cash flows after tax. So only after tax cash flows should be considered for calculation. So let's go ahead with this simple problem on converting cash flows before tax to cash flows after tax, and then using it in the various formulas or methods. The problem is, a company is thinking of purchasing a machine costing rupees 5 lakh. So what is this 5 lakh? This 5 lakh becomes your initial investment, because they are thinking of purchasing a machine which is costing 5 lakh. That means they are going to invest it right now. So it is initial investment, which has a life of 5 years. So life of the machine is also given, which is 5 years, and salvage value of rupees 50,000. Now salvage value, we already know salvage value is nothing but the scrap value at the end of the life of this particular machine. So after 5 years, if you want to sell this machine, you can sell it for 50,000 rupees. That is what salvage value represents. The company charges depreciation under SLM. SLM represents straight line method, or also called as original cost method. And tax rate is 30%. So tax rate is also given to us. So what they have asked, calculate ARR, NPV and PI, okay, at 10% factor. So we have to calculate ARR, NPV and PI. So if you understand, ARR is the non-discounted cash flow method, whereas NPV and PI are discounted cash flow methods. Okay, so let's understand what is given in the problem. Initial investment is given, which is 5 lakhs. Life of the asset is given, which is 5 years. Salvage value given 50,000. It is straight line method of depreciation. Tax rate is 30%, and we have to calculate ARR, NPV and PI at 10% factor. Then the cash flows are given to us from year 1, 2, 3, 4, 5. That is 2 lakh, 1 lakh, 1 lakh, 3 lakhs and 4 lakh. This is what is given to us. Now we have to calculate ARR, NPV and PI. Now how do we go about? First thing, always remember, if depreciation is given, understand if in the problem, then first thing is charge depreciation, calculate depreciation. Now how do we calculate depreciation? If you remember the formula of depreciation, since it is straight line method, the formula of depreciation is the initial investment minus salvage value divided by number of years. Correct? This is the formula. So what is the initial investment here? It is 5 lakhs. Okay, I'll just erase this off. Okay, initial investment is 5 lakhs minus salvage value, that is 50,000, divided by number of years. Now how many number of years? The life of the asset is 5 years. So 5 lakh minus 50,000 is 4 lakh 50,000, and 4 lakh 50,000 divided by 5 gives you 90,000, and it is straight line method, means every year the depreciation would be 90,000. I hope you're clear with this calculation of depreciation. Okay, so we have taken the depreciation values over here, 90,000, 90,000, 90,000, 90,000 and 90,000 for all the 5 years, since it is original cost method or straight line method. Once you calculate depreciation, we have to deduct the depreciation from the cash flows before tax. Okay, so 2 lakh minus 90,000 gives you 1 lakh 10,000. 1 lakh minus 90,000 is 10,000. 1 lakh minus 90,000 is 10,000. 3 lakh minus 90,000 is 2 lakh 10,000. and 4 lakh minus 90,000 is 3 lakh 10,000. So this is how we calculate cash flows before tax after depreciation. CFBT is cash flows before tax after depreciation is 1 lakh 10,000, 10,000, 10,000, 2 lakh 10,000 and 3 lakh 10,000. After charging depreciation, that is after deducting depreciation, we have to calculate tax. Now tax rate given to us is 30%. Now 30% on what? 30% on cash flows before tax after depreciation. So 30% of 1 lakh 10,000 is 33,000. 10,000 into 30% is 3,000. 10,000 into 30% is 3,000. 2 lakh 10,000 into 30% gives you 63,000 and 3 lakh 10,000 into 30% gives you 93,000. So this is how we calculate tax. Once tax is calculated, you have to deduct tax from CFBT. So 1 lakh 10,000 minus 33,000 gives you 77,000. What is that? That is cash flows after depreciation and tax. CFADT. Cash flows after depreciation and tax. How do we calculate that? It is cash flows before tax after depreciation minus tax. Okay. So 1 lakh 10,000 minus 33,000 is 77,000. 10,000 minus 3,000 is 7,000. 10,000 minus 3,000 is 7,000 again. 2 lakh 10,000 into minus 63,000 is 1 lakh 47,000 and 3 lakh 10,000 minus 93,000 gives you 2 lakh 17,000. So this is how we calculate CFADT, that is cash flows after depreciation and tax. I'll repeat, it is cash flows before tax after depreciation minus tax. So once you calculate cash flows after tax, after depreciation and tax, you have to calculate CFAT. What is CFAT? It is cash flows after tax. Now how do we calculate CFAT? It's given over here. Okay, CFAT is equal to CFADT, that is cash flows after tax and depreciation or depreciation and tax plus depreciation. Now the question is, why do we add the depreciation again? First we have deducted it, now why we need to add it? Because understand students, depreciation is a non-cash expense. We do not spend any money or there is no cash flow involved in depreciation. So we cannot deduct it. Then the question is, why did we deduct it? We deducted it to save tax. So depreciation is only used to reduce your tax burden. So once your tax burden is reduced, that is once you deduct depreciation and then calculate tax, the depreciation has to be added back to the cash flows. So we get CFAT. So how do we get CFAT? CFAT is equal to CFADT, that is cash flows after depreciation and tax plus depreciation. So 77,000 plus 90,000 is 1,67,000. 7,000 plus 90,000 is 97,000. 7,000 plus 90,000 is 97,000. 1,47,000 plus 90,000 is 2,37,000 and 2,17,000 plus 90,000 gives you 3,07,000. So this is how we calculate cash flows after tax. This is a very important step, adding back depreciation. Please do not forget to add back depreciation after deducting tax. The next step is, okay, let's go to the first one, that is ARR. Now since ARR is a non-discounted method, we need not find out the present value factors. These present value factors is for NPV and PI, which we will take later. Let us now just go for ARR, that is a non-discounted method. So how do you calculate ARR? We know the formula. ARR is average income divided by average investment. Okay, how do you calculate average income? Average income is summation of cash flows after tax and depreciation, that is CFADT. Please remember, in calculation, in investment decision, for all the methods we have to use CFAT except ARR. I am repeating, for all the methods we have to use CFAT for the calculation, except in case of ARR, where we use CFADT, that is before adding back depreciation. Whatever is your cash flow, that is considered for ARR only, accounting rate of return. Okay, so please don't get confused over there. I am repeating the condition. For all the methods of investment decision, we have to consider CFAT, that is after adding back depreciation. Whatever cash flows are there, that has to be considered for all the methods except ARR, that is accounting rate of return or average rate of return, where we consider cash flows after tax, after depreciation and tax, that is before adding back depreciation. Whatever cash flows are there, that has to be considered for ARR calculation. Okay, so what is average income? It is summation of cash flows after tax and depreciation, that is 4,55,000, divided by number of years, that is 5 years. This is given over here. So it gives us 91,000. So average income is 91,000. Similarly, how do you calculate average investment? Average investment is net working capital plus salvage value plus half of initial investment minus salvage value. So here net working capital is not given, so it is 0. Salvage value is given to us, which is 50,000, so 50,000 comes over here, plus half of initial investment. We know initial investment is 5 lakh, which we have seen over here. Okay, initial investment is 5 lakh given over here, so initial investment 5 lakh minus 50,000 is the salvage value again. So once you simplify this, you get the average investment as 2,75,000. So what would be your ARR in such cases? Your average income is 91,000 and your average investment is 2,75,000. So your ARR comes to 0.3309 or 33.09%. Okay, so the most important thing while calculating ARR is we have to consider cash flows after depreciation and tax for the calculation. That is before adding back depreciation. Whatever cash flows we get, that has to be considered for calculation of ARR, that is average income. Next is calculation of NPV. Now to calculate NPV, what do we require? We require a discount factor. Now discount factor is given to us, which is 10%. So first thing that we calculate is present value factors at 10%. So present value factors at 10% are 0.909, 0.826, 0.751, 0.683 and 0.621. These factors I have got it from the factor table, that is the lump sum table. I hope you're clear with this, getting these factors. Once you get the present value factors, multiply the factors with the cash flows after tax. So 1,67,000 into 0.909 gives you 1,51,803. 97,000 into 0.826 gives you 80,122. Again 97,000 into 0.751 gives you 72,847. Then 2,37,000 into 0.683 gives you 1,67,871. And 3,07,000 into 0.621 gives you 1,90,647. So once you calculate the present values of cash flows after tax at 10%, which is the discount factor given, we have to take the summation of that. So summation of present values of cash flows after tax comes to 6,57,290. Now once we calculate the summation of cash flows after tax, we have to go ahead with the formula of NPV and PI. So what is NPV? What is the formula of NPV? It is summation of present values of cash flows after tax minus initial investment. So what is the summation of present value of cash flows after tax? It is 6,57,290. So 6,57,290 minus 5 lakh gives you 1,57,290. So your NPV for this particular project is 1,57,290, which is positive. Similarly, we have to go ahead with PI because it is also at 10%. So what is the formula for PI? It is summation of present value of cash flows after tax divided by initial investment. Very much similar to NPV. But only thing is there we deduct, here we divide. Okay, so substitute the values. Summation of present value of cash flows after tax is 6,57,000 divided by initial investment is 5 lakhs. So 6,57,290 divided by 5 lakh gives you 1,31,000 okay. Just make the correction over this value. It is 6,57,290. Okay, 6,57,290 is this value, divided by 5 lakh gives you 1.31. So your PI is also greater than 1. That means this project can be accepted. So this is how we calculate ARR, NPV, PI or any other method when cash flows before tax are given. So I hope you're clear with conversion of cash flows before tax into cash flows after tax and then using it in the formulas. Okay, I'm repeating once again about ARR. Please be careful while considering ARR. We cannot consider CFBT for ARR. We have to consider cash flows after depreciation and tax. That is, before adding back depreciation, whatever cash flows we get, that has to be considered for calculation of average income in ARR. This is all about your problems related to cash flows before tax. I hope you're clear with all these calculations. Now some changes that may come is, instead of straight line method, you may get reducing balance method and a rate of depreciation would be given. I have also shown how to calculate depreciation at different stages. Okay, we have done this in the previous semester itself to calculate depreciation if it is reducing balance methods. Okay, I hope you're clear with all these calculations. Thank you. Have a great learning.